So I want to circle back to Old Dominion. Yes, volumes were down 8%, but LTL revenue per hundredweight, excluding fuel, was up 4.4% to $29.13. Revenue per shipment climbed about 6% to $514.56. And even on an ex fuel basis, revenue per shipment rose 4.7%. So they lost high single digit volume and still raised price mid single digits. That's definitely not a carrier in panic mode. That's really a carrier saying, we know what our service is worth and we're not going to discount it just because the market is soft. And this truly aligns with freight carriers in general. And listen, Old Dominion has the performance to back it up. For the quarter, Old Dominion delivered 99% on time service with a claims ratio below 0.1%. At that level of service, they don't have to be the cheapest option. On the brokerage side, C.H. Robinson is executing the same playbook, but in a different lane. Despite a significant increase in North American truck spot market costs, CHR's American Surface Transportation kept its adjusted gross margin flat at 14.6%. NAST, or North American Surface Transportation, revenues were up 2.8%, adjusted gross profits up 3%, and LTL adjusted gross profit per order increased 8.5%, while volume rose 2%. In other words, capacity costs went up, but CHR's margin didn't break. Their pricing and procurement engines absorbed the shock. So let's talk about capacity real quick. CHR reported that in its managed solutions business, the average routing guide depth increased from 1.3 to 1.5 in Q1. That sounds like a small move, but it's not. Here's what that means in practice. At 1.3, your primary carriers are accepting most of your loads. Maybe 1 out of 3 or 4 tenders has to roll deeper in the routing guide. At 1.5, you're getting pushed to secondary and tertiary carriers more often, and you're dipping into the spot market to keep freight moving. That's the canary in the coal mine for freight, saying, hey, excess capacity isn't so excess anymore. Old Dominion is positioning for that shift too. They generated $373 million in operating cash flow in Q1 and are planning about $265 million in CapEx for 2026, including $125 million for real estate and service center expansions and $95 million for tractor and trailers. You don't put that kind of money into the ground and into the iron if you think we're stuck in a multi-year freight recession. And if you zoom out to the broader market, the Cass Freight Shipment Index has started to move the right way. While Q1 year-over-year comps were still negative, Cass showed freight shipments up sequentially and signaling an early recovery in shipment activity. So you almost have this weird split screen. The year-over-year numbers do say a soft market, but the pricing, routing guide, and CapEx numbers say we're getting ready for the next upcycle.